Let's also bring on board Tai Hui, Chief Asia Pacific Strategist at JPMorgan Asset Management, joins us from Hong Kong now. Tai, hi, morning. Asian equities in the past few sessions have come under pressure largely due to the weakness in currencies. Do you expect this weakness to continue in the near term as well?
Well, I think the overall dollar strength is likely to continue going towards the end of the year. However, I'm more optimistic on the index performance of Asian equities, largely due to two factors. One is that the valuation of equities in Asia continues to be very attractive. And secondly, perhaps more importantly, we've noted that in previous episodes, higher US dollar interest rates are actually positive for Asian equities when interest rates are low. So both of which are supportive of our view that Asian equities should continue to perform well in the second half of this year.
Right, the Indian currency has fallen by about 5% only last 1 month, despite the dollar index falling to a near 1 month low. What do you make of that, and what do you think is having an impact on Indian currency?
No, I think the Indian rupee weakness is a reflection of the global concerns rather than domestic worries. If you look at Asian currencies in general, they've had a tough second quarter, not just the Indian rupee. So in that sense, I think it's much more of a global situation where dollar interest rate is likely to rise ahead of many other Asian currencies or other Asian interest rates, and that's helping the dollar to gain an upper hand against Asian currencies.
So do you think this current bout of weakness in Indian rupee could put flows in some kind of in danger?
No, I don't think so. I think if you look back to previous experience in India, we've had a very volatile Indian rupee trend over the past several years, but nonetheless, foreign investment inflows continue to be pretty robust and resilient, even at the times of weakness. So there may well be a bit of a breather, a bit of a pause in terms of inflows, but I don't think that's going to jeopardize a full year of inflow going into the Indian market.
So as far as growth is concerned in India, for about 2 straight quarters, we've seen about 5% growth levels in the economy. Do you think the economy has bottomed out and that investment cycle going forward is going to revive?
Well, I think the upside risk to Indian economy is larger than downside risk, in my view. And if you look at the investment growth, from a GDP component perspective, it did bottom out towards the fourth quarter of last year as well as the first quarter of this year. Compared to next to zero growth for most of 2012, we actually started to see a moderate improvement at the end of last year and the start of this year. That said, that's not quite as strong as we experienced back in 2010, 2011, and I think the recovery is likely to be a modest one.
If you expect a revival, then how would you play this theme? Would you pick up cyclicals in India?
Well, I think so. I think if you look at high-quality names, high-quality companies, they've enjoyed strong inflows from foreign investors, and also consumer spending continues to be relatively resilient. I do think that this will be a sector that we watch out for in the pickup of the Indian market.
What about financials? If your view is that Indian economy will rebound in FY14?
Well, I think again, we'll go for quality names in India in terms of financials. I think the potential steepening of the yield curve later on in the interest rate cycle should be positive for Indian banks. But also don't forget that the Indian banking sector continues to be very unsaturated. The Indian population remains highly underbanked, and that gives us a lot of scope for growth for Indian financials and banks.
But don't weak macros concern you?
Not at this point in time. I think, as we discussed earlier, we are expecting growth to bottom out in coming months, and therefore that should continue to be a supporting factor for the Indian stock market.
Now, India's central bank has been saying that due to twin deficits, only minor cool-off in inflation, it does not have too much of headroom or elbow room to cut rates. Do you expect rate cut in upcoming policy?
Well, we do expect more rate cuts coming through, and don't forget the RBF always adopted a very conservative stance in signalling its intention. So I think it's very much down to prevailing inflation, which I think is actually moderating to a great extent, and that should give the central bank some room for further easing.
Right, so how much importance would you give to these concerns of the possible Fed QE exit, and do you expect it to be gradual and orderly, or do you think it's going to be sudden?
Well, the Fed exit, I think it will be gradual and orderly. However, the reaction in the bond market may be a little bit more volatile. I think that's what's concerning the market right at this point in time. It's not so much that the Fed will gradually reduce liquidity provided to the markets, but rather the very volatile reaction by the bond market. But overall, I'm expecting further upside to equities, really on the back of the stronger U.S. economy rather than the higher funding costs that can be expected over the next 1 to 2 years.
Now, Indian markets have already wiped out their 2013 gains. Do you still expect positive returns by this year end?
I do. I still expect Indian market to do better than at the end of this year than how we started. Partly, if you look at history, Indian market has always been a strong performer when global growth is normal or strong. The only time they will underperform is really during a downturn in the global economy or a crisis situation as we experienced back in 2008. So I'm still quite confident that the Indian market will end the year on a higher note compared to how we started in the first half of 2013.
But where would you look to increase exposure when it comes to Indian markets? Which sectors, according to you, offer value right now?
Well, we still think that cyclicals are the place to be, even though it may command a bit of a premium. I think investors are willing to pay a premium for growth they can see. And therefore, the cyclical parts of the market continues to be our favorite.
Right, we've seen good inflows in Indian equity markets this year. How is the mood among foreign institutional investors?
Well, I think in the short term, I think the market volatility, especially in the bond market, will continue to be a negative factor. But over the longer term, attractive valuation, stronger growth momentum, and possible policy easings, these are all positive factors leading to the Indian market. So I think what we're seeing right now is short-term conservative attitude, but longer-term investors are continuing to be very constructive on the Indian market outlook.
So what do you make of the weak China data which was out over the weekend?
Well, I think, frankly, if you look at the fixed asset investments as well as retail sales numbers, the consumption and investment part of the story is more of the same. Export numbers clearly have decelerated, but I think that's partly to do with the tighter regulation or tighter monitoring of the accuracy of the data rather than a loosening of momentum itself. So in that sense, I think the market's been ignoring the strong export data for the past 3 or 4 months and have assumed that export continues to be lackluster. So in that sense, I think we still maintain a long-term positive view of China for 2 reasons. First of all, valuation in Chinese equities continue to be very attractive. And secondly, with the market expectations of China continues to correct lower, I think that will be a point where the data will actually meet expectations, and this is where we could see more upside to Chinese equities.
What is your position on China now?
Well, we do like cyclical for the reason that we are expecting growth to moderately accelerate in the second half of this year, especially in areas such as financials, where banks' valuation is incredibly attractive. And I think a lot of the bad news, such as potential deterioration in credit quality, has been priced in. Consumer discretionary and staples, both of which are also looking pretty strong on the back of ongoing income growth in the Chinese economy. Where we are more conservative about is perhaps in the materials and also in the industrial side, where export performance continues to be lackluster, and that will only improve once we start to see demand from the US and Europe, as well as other parts of the world start to recover.
So what do you make of the improving economic data coming out of Japan, though?
Well, I think given the recent very sharp correction in the Japanese market, it's not particularly easy to convince investors to jump in right now. But I do agree with you that the improvement in the Japanese data, both in the GDP and current account, and also we're seeing consumer confidence and the land prices start to pick up, all of which are suggesting that the first stage of Abenomics is actually working, is changing market sentiment. Obviously, the market seems disappointed with the growth strategy put forward by Prime Minister Abe, but don't forget, any of these reforms are going to be multi-year rather than multi-weeks or months. So in that sense, I do think that Japan continues to be a constructive story from our perspective in the long run, but obviously the momentum at the moment seems to be on the downside.